All right. So I haven't explained the difference to you yet between cash-based accounting and accrual-based accounting. Just been sort of introducing accrual-based accounting to you, and I'll tell you the difference now. So cash-based accounting is the one that seems like you would just naturally do. It means when somebody pays you cash, you record that as revenue, and when you pay somebody else cash, you record that as an expense. But it's the easiest way to do accounting, but it's also kind of problematic. And the reason it's problematic is because we don't always get paid for all of our revenue at the time we actually do the work, right? And so it can be confusing, I guess, to what's really happening. For example, I used to work with a guy when I was doing consulting who built houses, and he would sometimes get paid for like the whole house in advance, but he didn't really earn all that. So if he'd recorded that all as revenue, all $350,000 in January, and then he'd spent money over the next 4 months building the house, that revenue that he recorded would not match up with the expenses that he was recording. So it would look like he had made a ton of money in one month, but had no expenses, and then had all these expenses in the other months, when really that needs to be tied together, since expenses are the costs of earning the revenue. So instead, what we are required to do by GAAP, which I mentioned briefly in chapter one, generally accepted accounting principles, those are the rules that you have to follow as an accountant, is we have to follow what's called the accrual basis of accounting, um, which is we record revenue when we earn it, regardless of when we actually receive it. So if we get paid in advance, then instead of recording that all as revenue, we actually record it as a liability called unearned revenue. And then as we earn the money, we adjust, or we create what's called an adjusting entry to move that unearned revenue over to revenue. Okay. Likewise, if we pay for something in advance, then we will record that as an asset called a prepaid expense, which we've already seen in some of the exercises we've done. And then as we derive the benefit of that asset, so if we had like prepaid rent, then as we live in the building for a month, we'll do an adjustment to show that we've now earned some of that, or not earned, we've actually used some of that. And we would do an adjusting entry to record the expense and reduce the amount of the asset, prepaid rent. So this accrual basis of accounting makes the accounting a little bit harder, but it makes the data much clearer because we're only dealing with the things we've earned, or the expenses. The word they use in accounting is incurred, which means actually received some benefit in exchange for that expense. Okay. So that's what this whole chapter three, is about: switching over in our minds this idea of, getting rid of the cash basis of accounting and focusing on the accrual basis of accounting, and then the adjustments that we have to make at the end of each month in order to account for this revenue we've received in advance and have now earned some of, so we have to adjust it to show we've earned it, or the expenses we paid in advance and have now incurred. Okay, so that's what this chapter is. I'm going to warn you up front. This is usually the hardest chapter for everybody. Like this, for some reason, it's like easy to get your brain confused and mixed up on this chapter. So it's a challenging one. So just be prepared for that. Just be prepared to put in the work to try to understand it. Also, I mentioned last week that we have an exam that's due by the end of this week. How many of you know where the testing center is? Any of you? Okay, then I better explain it. So in the AP building, that's the building where like math classes and English classes are held. Big brick building right up that way. In the AP building is the testing center, and you have to just go in there, and they'll ask for either your student ID or some ID to prove it's you. And then for whatever, like, you'll probably have other teachers who do exams there too. And And so once you prove it's you, then they'll like look at the rules. And if it says like you can have notes, they'll let you have notes. They have a little cubby for you to leave your cell phone and stuff in. Okay. Which means if you need a calculator and you've been using your phone as a calculator, you need to get a calculator. You don't have to buy one. I believe the library has some you can check out. I'm not sure. Um, Either for a day or for longer if you need it. Yeah. Oh, and do they have some up at the testing center? Has anybody taken? Okay. Okay. And since our math for this class is honestly just addition, subtraction, multiplication, division, mostly, right? We're not doing crazy stuff. You don't need like, I was gonna say, if you were doing a math class, say like statistics or something, and you needed a statistical calculator, then like it's nice to have one you're familiar with and not be given a random one. But for this class, it's probably fine, like whatever calculator they have. You can also use Excel, stuff like that. So for this first exam, and this is the only one of my exams like this, and I already told you this once, but no notes, no book, no nothing. It's completely closed book. Okay. And it really only covers the stuff we covered in chapters 1 and 2, and really only covers chapter 2, if we're being honest. Okay. So it's just that I need for you to have the debit and credit rules completely figured out. Because if you don't, if you kind of faked it through the assignments and used checks and never really thought deeply about those rules, you're going to be hurting for the rest of the course. I need debit and credit, like the making of journal entries, to become natural to you and like something you can just do without having to think a lot about it. So that may mean you need to put in some work this week to like get it. Okay. One thing I'll show you, I know it's scary, but you're very capable people. I've been around you enough already to see that you guys are smart. They're like, boy, have we got you fooled, old man. And I'm like, I'm not that old. That's mean. Although I was just with my grandkids this weekend, and my oldest one is 8, which is old enough that they start like being smart, normal people that can talk to you. And then you're like, I am old. This child of my child is like getting grown up. So if you go into the module and you look at the chapter, I said yuk. If you look at the chapter 2 module, there is a review here, and it's kind of like a little practice exam. You can do it as much as you want, gives you feedback. If you go through that a couple times to where you're like, I'm comfortable doing this, you're gonna like do really well on the exam. I'm kind of like a no surprises exam person. I don't want the exam to feel radically different than what you've practiced. There may be a few little twists. That's just how we separate the geniuses from the super geniuses, but mostly straightforward. So look at that review as you prepare for the exam. Okay. All right, we better get on with chapter 3. All right. So I mentioned this already. The revenue expense recognition, or sometimes they call it the revenue recognition principle, which is what I just said. Revenues are recorded when they're earned, which means when you do the work for them. Okay. And expenses are recorded when they're incurred, which means when you receive the benefit of them. Right. So if I just go out and like buy some supply or not supplies, that's a tricky one. If I go out and pay for insurance, um, or for my well, utilities is a good one because usually you pay that at the end of the period, right? They go out and they check your meter, see how much you've used, and then you pay for it. That expense I would just record right then and there. I get the bill, I pay it, record it. Why? Because I've already received the benefit of that. But if I'm paying for my insurance for the next year, I can't really record that all as an expense. I have to record that, if it's $1,200 for the year, then what I would do is record a prepaid insurance, which is an asset when I pay for the insurance. And then each month I would do an adjusting entry to show that I'd used up $100 worth of insurance. And then at the end of the year, that prepaid insurance will be totally used up and will have been expensed as $100 a month across my. That's all. That's all we're doing for this chapter. All right. Sometimes you'll see this term matching principle, and that's all it means is that the revenue and the expenses incurred to earn the revenue are matched, meaning are applied in the same fiscal or financial or accounting period of time. That's all. All right, so this leads us to the adjusting process. All adjusting entries that we create are going to be dated the last day of the financial period. So if it's for a month, then it'll always just be dated on the last day of the month. If small businesses like my businesses that I own, we typically only adjust once a year because we just don't have that many transactions. So at the end of the year, and we don't need up-to-date financial statements every month. We just need it at the end of the year so we can do our taxes. So we do an adjustment at the end of the year. But you'll notice the adjusting entries always end up at the end of the financial period you're dealing with. And then this right here, all adjusting entries are affect at least one income statement account and one balance sheet account. This matters because if you're getting confused about it and find yourself putting in weird stuff, if you take a breath and say, is there one income statement and one balance sheet account being affected here? It's a good sign you're on the right track. If it's two income statement accounts, like if you're doing a revenue and an expense, something's off. Or if it's two balance sheet accounts, something's off. So that's just a good thing to know, and it'll make more sense as you do some of them. So it always involves a revenue or an expense and an asset or a liability account. That's the rules with adjusting entries, and you'll see why in a minute. So they use the term accrual, which is a weird sounding term that we don't use a lot in the regular world. Does anybody know what it means to accrue something? Have you ever read that or heard that word? So to accrue usually means to sort of like save up over time. Like they'll say like this person accrued their wealth through hard work and industry and saving, right? So it just means like they didn't get rich all at once, like by winning the Powerball, 1.1 billion. If you ever do the math on it, though, like mostly lottery is just a tax on the people who are bad at math, right? Because your chances of ever winning are low or winning anything substantial. But 1.1 billion, so I don't know. If you take the cash option, you still get $550 million after, that's a pretty good deal. Don't do it. All right. Like our teacher was telling us we should go buy lottery tickets. I didn't say that. I didn't even imply it. All right. I was just remarking. You know what $1 billion is? It's 1,000 million. A billion is 1,000 million. And I can't like picture having a million things in my hand, so I have to go down to thousands. A million is 1,000 thousands. I know what $1,000 is. Used to be more than it is now. Really, it was always 1,000, but I could get with it. Like what's your rent? 400 a month, 500 a month, 600, depends on where you live. So we know what 1,000 is. And then if you had 1,000 of those, you have a million. If you had $1 million and you invested it and earned 6% on it, that would generate income of $60,000 a year. Pretty good. You could live on that if you were careful. Single, you could live on it pretty good. Date kids, no. Right. But if you had $1 billion and you earned 6% on it, that would be $60 million a year in interest. So, okay. Sometimes I try to get a scope of what I'm working with, and a billion's just that big that I can't fully grasp it. Right. All right. Nobody likes me waxing philosophical about money, I guess. All right. So let's talk about accrued revenues and accrued expenses. All right. So an accrued revenue is where our revenue has been earned. Let's wait a second. Or no journal entry has been made. Okay. So accrued revenue is where we're earning revenue, but we're not yet entering it. This is very common in businesses that do they just do work for customers as they go. Businesses like lawyers, accountants, where what we do is as we work for a customer, we just record that we've done so many hours of work. And then at the end of the month, we bill them for all the work that we've done. Okay. So we're accruing revenue, we're gaining revenue as we go, but we have not yet entered it into our journal. Okay. Very normal in some businesses. It's even normal in businesses like landscapers. They'll just go out and do work for customers and then bill them at the end of the month. And also utilities. Like I said, you're using the utilities in your house, which means in theory that the utility provider is earning revenue. They're providing utilities to you, but they don't record it as they go. But once a month, they go out, read your meter, or now they have electronic meters they can just read, but they check the meter and they bill you. So our initial transaction is that there isn't one. No revenue has been earned, but it hasn't been recorded yet. And then at the end of the period, they do an adjustment, right? They figure out how much revenue they've earned by looking at all the customers they've done service for, and they enter an adjusting entry. The debit to accounts receivable, that means money owed to them, and a credit to revenue. So pretty normal. A lot of businesses do it. You don't record as you go, but at the end of the financial period, you enter this adjusting entry into your records to show accounts receivable, money owed to you, and revenue that you earned during that period. Just all recorded in a lump at the end of the period. Okay, that's called an accrued revenue entry. And then what will happen in the future? What do you think? Still looking at that top one. So this is our adjustment. What will happen going forward? We'll start, if people owe us money, we'll start to collect that money, right? So the adjustment is accounts receivable, money owed to me, and revenue, money I've earned. And then in the future, when people pay me, I'll record cash going up, my debit to cash, and accounts receivable going down. Once people have fully paid me off for all the money they owed me, my accounts receivable will have dropped to zero, right? So you'll also notice that with adjusting entries, they never have cash in them. Okay. So they get resolved by cash. And what I mean by that is this creates money owed to me. To me, when I'm owed money, that's kind of like tension. Will they pay me? Will they not? Also, when I owe people money, that's kind of like tension. Like, oh, I hate owing people, but I'll have to pay them. So the adjusting entry in this case creates the receivable, and then the cash resolves it down the line as people pay me what I've billed them for. Okay. So that's an accrued revenue. An accrued expense is where we've incurred an expense, but no journal entry has been recorded. So we get to the end of the month and we say, are there any expenses I've incurred during this month that I need to make sure I record so they're on my income statement, right? We need the revenues and expenses to be correct on our income statement. So we get to the end of the month, we look at any of those expenses we've incurred during the month and create an adjusting entry where we debit the expense and credit accounts payable. And then that will be resolved in the following period, usually by me paying off my accounts payable, which would be a debit to the accounts payable and a credit to the cash. Okay. So that's the process with accruals. They both have to do with us either earning revenue, but not yet having recorded it, or incurring an expense and not yet having recorded it. And then before we close out our books at the end of the month, we need to make sure that revenue shows up and that expense shows up. So we just check back and the things and the revenue we've earned and the expense we've incurred and record them. That's all we're really doing. Okay. All right. So here's an example. Net Solutions signs an agreement with Dankner. That's like back when they had dank memes. Like that meme was dank, but this other meme was dankner than that first one or something. I don't know. I guess that'd be danker. Do they still have dank memes? Is that a phrase that even gets used anymore? Yeah, but you've heard of it. I was watching some of the old Vines the other day, and I was like, still good. They're still good. All right. Assume that Net Solutions signed an agreement with Dankner Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, Net Solution had provided 25 hours of services. So part of the reason this chapter gets confusing to people is it will give it to you like this big word problem, right? And you have to be like, what does that mean? So what they're saying is if I provided 25 hours and my agreed upon rate was $20 an hour, I'll take 20 times $25. I mean, 25 times $20, which will be what, 500 bucks? And I need to now recognize before I make my financial statements, hey, I've earned $500, even though I haven't paid for it yet. Because in real life, what are they going to be doing? They're going to be writing a bill to Dankner Company saying, please pay us $500 for the services we rendered this month. But in their books, they need to record that they've earned it. So they'll do an adjusting entry dated the last day of the month for accounts receivable. Money owed to them goes up by $500, and fees earned, which is their revenue account, also goes up or is credited by 500. So that's the adjusting entry. Like I said, what's hard about these is they'll give you this word problem and you got to think a little to figure out what they're talking about. All that means is we know we did work for these guys. Let's add it up and record it at the end of the month. So that revenue shows up on our income statement and that accounts receivable shows up on our balance sheet. All right, let's do a practice one or two. Give you guys a minute because I'm sure some of you didn't log in, even though you know how this goes by now. But it's okay. I'm not judging you. Well, I'm judging Carter, but nobody else. Oh, that's true. That's confusing. Carter 5, not Carter 8. You're Carter 5, by the way. Yeah. Well, I don't know who the others are, but you're the Carter whose student ID number ends in a 5. I seriously thought it was an error when I got my thing. I was like, they must have put this guy in twice. It's different ID numbers. Where's Carter 8? Oh, you snuck in. Okay. It wasn't very sneaky. Like could be a tardiness ninja, and then they're in their seat. It's way better than me having like a shuriken in my throat. You know what I'm saying? If I had to deal with one kind of ninja, what? A shuriken, like a throwing, like a throwing weapon, like a throwing star. Yeah. I'm sure my pronunciation's not good. I don't speak Japanese. That'd be cool too, though. Like as you're gurgling in death, you're like, something sweet. Like that. All right. Everybody there? All right. Just so you know, if I ever been like, am I going too fast? Or is everybody there and you don't answer? And then I move on and you're not ready? That's your own dang fault. Because I gave you a chance to respond. Okay? Because I care deep in my heart of hearts, my blackened accounting heart, like that, just shriveled. Maybe I could be the accounting Grinch and my heart will grow 3 sizes this semester. It'll be beautiful. All right. At the end of the current year, $17,555 of fees have been earned but have not been billed to clients. Not journalize, just journalize the adjusting entry to record the accrued fees. Okay, so this one's pretty straightforward. No crazy word problem, right? Just tells us the amount. So I'm going to record this as my accounts receivable, money that's owed to me, going up, which means a debit. You're able to get into it did you go straight into Cengage? You can't even log straight into Cengage now? No, because when we looked at it last time, you could get in there. And then we're going to credit fees earned, right? Because fees earned is its normal balance is a credit. And that's it. That's the adjusting entry. This says, hey, accounting records, increase my accounts receivable by 17,555 and increase my fees earned by 17,555. We've accrued this revenue. Piece of delicious cake. Does anybody here like German chocolate cake? You're not weirded out by like the little bits of coconut? I love the taste of coconut, but like then after like, you've swallowed your cake and everything, there's always like a lingering little bit of coconut somewhere in your mouth. I don't love that. All right. Look at the next one. At the end of the current year, $59,500 of fees have been earned but not billed to clients. Journalize the adjusting entry. So again, pretty easy. We'll debit accounts receivable. We'll credit fees earned. And then the second question, if the cash basis rather than the accrual basis had been used, would an adjusting entry have been necessary? And the answer is no, because we would just not record any revenue until they pay us, which sounds, like I said, like easier. I don't have to worry about these adjustments and stuff, but it wouldn't be very accurate because we'd be showing things in months when we hadn't earned it. Okay. So we'll say no, check our work and be like, we're 40% done already. This guy's a great teacher. That's probably what you're thinking right now. You're like, he's that guy. He's amazing. He's totally worth double the tuition I paid. Like that. They're like, well, I try, people. Still working on it. All right. All right. He's so self-effacing and humble, kind and generous. Just the best teacher of all time. Something like that. I mean, I'm not exactly sure what you're thinking. Hold on, let me mark Carter Bryce 8 here. Who else snuck in? Oh, Jerusha. All right, you're a good person. Jeffrey Larson sneaking. Oh, there he is. I saw you already too. I just didn't make the connection. And Jake Layton, I didn't see him. And Brickell. Oh, you were here all along. Sorry. But you sat back there last or the week before. Okay. All right, sorry. People are like, why do we have to do this? It's like high school taking roll. And I'm like, I agree. All right. But I think what's happening is the Department of Education. Did I close out of that presentation? Oh, no, here it is. The Department of Education will not be content until they have done to colleges what they did to high schools. So we keep getting more and more federal things, and pretty soon it's just like extended high school. Sorry. All right. So accrued expenses. One of the more common ones is payroll. And this happens because we'll often like here at the college, we get paid like every other Thursday. And so at the end of the month, the college has to record how much like wage expense they've incurred, even though like we're not, it's like in the middle of a pay period. So they have to record, oh, like our employees have earned this much money up to the end of the month, and they have to record that as like a wage expense, and then a liability called wages payable. And then when they get to the next payday, they have to record that now they've paid off that liability, right? By paying the employees. Plus, they have to record that they paid us for whatever, how many days were in the beginning of the next month. But they have to put their wages in the correct months, right? And so they have to record the fact that they have incurred that cost, even though they haven't paid it and won't pay it until the next payday. So that's a very common accrued expense that we'll see as we do this. So the example here is Net Solutions pays its employees biweekly. During December, Net Solutions paid wages of $915 or $950 on December 13th and $1,200 on December 27th. These payments covered the pay periods ending on those days. As of December 31st, Net Solutions owes $250 of wages to employees for Monday and Tuesday, December 30th and 31st. So their employees worked but we haven't paid them yet because we're not going to pay them till the next payday. Okay. So our wage expense has increased by $250 and our wages payables increased. So we have to do an adjusting entry to record that. So that's what it'll look like. We debit wage expense and we credit wages payable, or the expense goes up by 250 and the payable goes up by 250. Always when we're doing an accrued expense, we're going to debit wage expense or whatever the expense account is and credit some sort of payable. Okay. That's how accrued expenses work. It means we've incurred the expense, but not yet paid it. So at the end of the month, we look, are there any expenses we've incurred during this month that we haven't paid during the same month? And if so, we need to record them at the end of the month so they'll show up on the income statement. Because the income statement, to be accurate, has to show all expenses we've incurred during the month. We have to match them to the revenue we've earned during the month. So again, like I told you, like this chapter is hard, but the concept's not that crazy, right? Get to the end of the month and be like, are there any revenues we've earned but haven't recorded yet? Let's make sure we get them recorded before the end of the month. Are there any expenses we've incurred but haven't recorded them yet? Let's make sure we get them recorded before the end of the month. That's all really. That's all that we're really doing with the accrued uh, revenues and expenses. But for some reason, it's easy to get it smooshed around in your brain. Then on the next paycheck, January 10th, it'll look like this. They'll say, oh, okay, we paid wages of $1,275 on January 10th, 250 of which it was just paying off that amount that we did as a payable at the end of the previous month. And then the 1,025 was all wage expense for January. Does that make sense? We recorded the expense for December and December, but then we paid it off on the next paycheck in January. So that's all that's doing, is it's showing the new expenses from January 1st to January 10th or 10/25. The wages from the last 2 days of December were 250 that we're paying off, and our cash is going down by 1275. That's the resolution of that adjusting entry when we pay the cash. So 3 more problems, and then we're done. Don't you love that about accounting? You'd be look at it, you'd be like, oh, I only have like 6 problems. And then each problem is like 57 steps. And you're like, that's bull crap. I thought I was gonna be done with this in 30 minutes. You started to like adjust your expectations. Flow, peace, like the river, like that. You have to drop your voice really husky when you say it. I will help you find peace, like the river, like that. I could sense that I just set you guys at ease about this whole process. You're welcome. All right. You're lucky you have like the most humble, gracious teacher in the whole world. Since you're not laughing, I'll assume that means you already knew that I was that humble and gracious. All right. So, Prospect Realty Company. They pay weekly salaries of $27,600. It's pretty good. 27 grand a week. That's a good sized company, right? They pay them on Monday for 6-day work week, ending the preceding Saturday. That's a little confusing. Journalize the necessary adjusting entry at the end of the accounting period, assuming the period ends on Friday. So, here's this. This is why these start to get tricky. So it tells us it's 27,600 for their 6-day work week, Monday through Saturday, right? So Monday through Saturday, they pay $27,600. That's 6 days. So what is 1 day worth of salary? How would we figure that out? Just divide it, right? So what's 27,600 divided by 6? You said 4,600? So they pay $4,600 a day for their employees, right? That's the salary expense that they incur each day. Think about that. That's pretty normal. We don't pay, most places don't pay you daily. That'd be kind of dope if they did, except you'd blow all your money and then wouldn't be able to pay your rent. Like, I got paid every day. But they don't actually pay it until usually every other week. Like some places pay twice a week, or I mean every 2 weeks, and some pay twice a month. A little different, right? So this says the accounting period ends on a Friday. So how many days would they have incurred as of a Friday? 5, right? Monday through Friday, that's the end of the month. So the sixth day, Saturday, won't occur until the next month, which would be tomorrow, but that's the start of the new month. So to figure out how much to adjust, then we take 4,600, the daily rate, times the number of days, 5 days. So what is that? 20,000 plus three, is it 23,000? Okay. Everybody understand the process though? Divide to get a daily rate, then multiply the daily rate times the number of days that you're doing the adjusting entry for. We're doing it for 5 days because the pay period or because the month ends on a Friday. So the people have earned their wages Monday through Friday that we want to be on this month's, and then the Saturday one will be on the next month's records. Okay. So what did I say? 23,000? Okay. So I'm just going to do wage expense or salaries. Whoops, not receivable. Salaries expense and salaries payable, 23,000. So we'd say we've accrued the expense or incurred this expense of $23,000 in pay up to the end of the month. We want it to record it now so that it will be on our income statement for this month. Nice. All right, Paradise Realty, what the pays weekly salaries of 25,500 on Friday for a 5-day work week ending on that day. Journalize the necessary entry at the end of the accounting period, assuming it ends on Monday. Okay. So that's just one day's worth then, right? The people worked on Monday that we need to get on this. They would have been paid previously for last week, but we need to do adjusting entry for Monday. So again, we just take it's a 5-day work week. So we take 25,500 divided by 5. Which gives us what, 5,100? Is that right? Check my math. I get overexcited sometimes and do it wrong. So right. Okay, thank you. So again, and then it's just one day's worth, right? Just that Mondays that we have to do the adjusting entry for. So we're going to do salary expense, salary payable. And then it says journalize the necessary adjusting entry at the end of the accounting period, assuming that the accounting period ends on a Thursday. So now you have Monday, Tuesday, Wednesday, Thursday, 4 days worth for this second one. So we would just do 4 times 5,100, which should be 20,400. So they're just giving us two scenarios here. But the accounts at play are still the same for all of these adjusting entries. When it's an accrued expense, it's always debit and expense, credit a payable. When it's an accrued revenue, it's always debit an asset receivable, credit um, credit the revenue account. What did I say? 4 times 5,100 was 20,400, right? Be able to get into it? Yeah. Dope.
What's the point of buying the textbook? You can just do it like this.
Well, you did buy it. It's somehow just not linked to the class. So so that you can use the direct link in. So now we'll have to see when you submit, does it also link the grade back to the class, or am I going to have to go in there and manually move it over? Like that's what we're trying to. All right. Everybody good on that one? All right. Last one. What time is it? We're going to get out a few minutes early. You're welcome. Not that many minutes early, though, so it's not that great. All right. Determine the wages payable and wage expense accounts at August 31st after adjusting entries have been posted at the end of the first months of operation. Um, Wait, the wage payable and wage expense accounts after adjustments have been posted at the end of the first month of operations are shown. That I feel like the grammar of that is weird. All right, are shown in the following T account. The wage expense, 27,500. So that's how much we've incurred. And then wages payable is $5,250. I think what they're saying is how much do we actually pay this month versus how much is still owed, right? So really all we're going to do is take the $275,000 in wages incurred, subtract out the 5,250 we haven't yet paid, and that'll be how much we've actually paid, and then we'll pay the remaining 5,250 in the next month. I think that's what they're trying to get our brains to go. So 275 minus 5,250 should be 269,750. Hey, got it right. So I think what they're trying to show us is we can incur expenses, but we don't always pay them all during the same period, right? It's very normal to have some expenses that you've incurred this financial period not be actually paid with cash until a future financial period, but we still need the expense to show up during this period. So one last quick thing, and then you guys can get out of here. I mentioned that we have this accounting cycle we're working on, and that step one was the journal entries. Journal entries. That's that chronologically, we do a journal entry, debit, credit, each time a transaction occurs. And then we move those journal entries to our ledger. That's where we keep a total of the balance of each of the accounts, right? We either use the T account ledgers, or there was the ones that like show the running balance on them. From our ledger, then, as we get to the end of the month, we create what's called an unadjusted trial balance. And we saw that in the last chapter. That's that document that has all the accounts and their balances listed either as a debit or a credit. And then, yes, if you tally it up, it should have the same amount on the debit side and the same on the credit side. That was in chapter 2. We learned about that. So after we do our unadjusted trial balance, then we do adjustments, which means, is there anything on this trial balance that's not yet in the accounts? So we do adjustments. That's what we're learning about now in chapter 3. And after we do adjustments, we'll create an adjusted trial balance, which will be the balances of all of our accounts after the adjustments. Once we've done that, now we're ready finally to create our financial statements that we learned about kind of in the beginning, an income statement, a balance sheet, and a statement of stockholders' equity. Because we'll know it's the end of the period. We've done all of our adjustments, so all of these numbers are right. Now we can plug them into the reports and that's what we're doing is we're creating reports to communicate then to the owners of the company, to our investors, to our lenders, to the government if we have to do taxes. Here's what our revenue and our expenses were for the month. Here's what our assets, liabilities, and stockholders' equity are at the end of the month. Here's where our stockholders' equity stands at the end of the month. So this whole process, if you think about what accountants used to do when they did this all by hand, this was all month long, just recording transactions, recording through the ledger too, so you can keep the balance going. And then creating this unadjusted trial balance was usually done like on the last day or at the end of the last day of the month. Doing the adjustments was done on that same day, last day of the month. doing the adjusted trial balance, same day, financial statements, and then starting over with journal entries for the next month. Now computers do most of this for us. So we just enter in the journal entries and the rest of this is all created for us. The reason you're having to learn about it is because you're business majors, most of you, and you need to understand how money flows through a business and how accountants do it. Even if you're never going to be an accountant, you need to understand the basics of how it works so that when you get that printed out report, you understand like how that came about. Does that make sense? So this course and accounting 2 are just trying to give you a sense of that. Like, here's the whole process that our computer systems now use to figure it out. Here at the college, we have a bunch of people with accountant in their title, and most of them make $30,000 to $50,000 a year. And then we have one person whose title is controller, and it happens to be a man at our institution here. He has to know where all the money goes and how it all works. He has a CPA and everything else. And his salary is like $130,000 a year. So your question is, if I do accounting, do I want to be a $30,000 or $40,000 a year accountant or a $150,000 a year accountant? And the difference is knowing where everything goes. But also, like when the auditors come, guess who has to sit and talk with the auditors and explain things to them? The guy that makes the big money, right? Not big money, but big money. So you're like 150, that's nothing. That's what I make now as a student. All right. Have a great day. We'll see you tomorrow. Hope you had a good Monday. Sure. I would love to go back up to questions 1 and 2.